Welcome to Geojit Spotlight. In today's video, we speak with Dr. Vijayakumar, Chief Investment Strategist at Geojit, on the global market rebound following the pause in reciprocal tariff by Trump. We also explore what this means for Indian markets and your investment strategy going forward. Welcome, sir.
Thank you.
So during the last many days, there have been major changes in international trade policy, particularly after the declaration of reciprocal tariff by Trump on April 2nd. This triggered big volatility in the stock and bond market. For the benefit of our viewers, please give a brief background of these changes and their consequence.
As you said, there has been big changes in the international trade situation, particularly in the international trade policy during the last many days. All these changes were triggered by President Trump, particularly after the declaration of the reciprocal tariff policy on April 2nd. Trump imposing higher tariffs on other countries was expected by the market and therefore partly discounted, but nobody expected very high reciprocal tariffs. Reciprocal tariffs themselves were not reciprocal. They were much higher than the reciprocal tariffs. If reciprocal tariffs were to be calculated on a logical manner. And therefore, when this totally unexpected steep reciprocal tariffs came, there was a big sell-off in the stock markets. Big crashes happened in all the markets, particularly in markets which were highly integrated with the US markets like China, Vietnam, Taiwan, etc. The crash was lower in India, but there was a crash. But then what happened after that was a total surprise. President Trump had to retreat from his reciprocal tariff declaration because the bond market behaved totally in an unexpected manner. During normal times, even during times of crisis, institutions will buy more of American bonds, American treasuries, because American bonds are the safest asset class in the world. But what happened this time was just the reverse. There was big selling in American bonds. So the prices of American bonds declined. Bonds and bond yields are inversely related. So when the price of bonds declined, bond yields shot up. And that created a lot of flutter in American policy making circles, because that can create a financial meltdown in US. American treasuries are the foundation of the American bond market. And therefore, everyone became a little bit scared. And President Trump had to declare a pause, a 90-day pause on the reciprocal tariffs declared, except on the tariffs declared on China. And also he has said that the baseline tariff on 10% imposed on other countries will remain. And also the 25% duties imposed on steel and aluminum and automobiles, that also will remain. But for everything else, 90-day pause was declared. So that is the background. And their strategy now is to use this 90-day gap to have negotiations with other countries and reach a settlement regarding a bilateral trade policy.
So will the rally in the market sustain?
Well, now we are having a rally in the market, in the Indian market, because when the other markets rallied on April 10th, we had a holiday. But in this present context of elevated uncertainty, it would be difficult for the rally to continue, because the market does not like uncertainty. So in uncertain times, there will be always some fear about what is likely to come. And what is likely to come from President Trump, nobody knows. What we will say next month or next week or even next hour, nobody knows. That uncertainty is there. Therefore, the rally may happen, but a sustained rally would be difficult. More important than that, in India, our rally has been made weak by the weak corporate earnings. If you take the 3-year period during financial year 22 to financial year 2024, 3-year period, FY22, FY23, FY24, the market delivered more than 20% CAGR returns, impressive returns. During this 3-year period, corporate earnings also grew by more than 20%. That is why we had impressive growth in the market. But last year, financial year 25, the corporate earnings grew only by less than 5%. We are yet to get the final figures, but the latest estimates is that the Nifty earnings growth will be less than 5%. That is one of the reasons why Indian markets are even now not attractively valued. Nifty is now presently trading at 20 times FY26 estimated earnings. So 20 times is higher than India's 10-year PE ratio of 18.5%. That's why a sustained rally will have to wait for big turnaround in India's growth and corporate earnings.
How India's macro situation now, sir?
Well, we must understand as investors that India is in a relatively sweet spot. Of course, a global growth decline will impact all countries. One thing that can be said with a lot of certainty in 2025 is that US growth will be sharply down, less than 1%. Even a US recession is possible. Growth in China, the second largest economy, also will be down. It can be less than 4%. So when the world's largest economy and the second largest economy slows down, global growth will slow down. So when global growth slows down, all economies will be impacted by that. But India will be impacted less because ours is a domestic consumption driven economy. So our growth rate projection for FY26, RBI's latest projection is 6.5%. That is achievable for India because India's economy is now in a macro sweet spot. We have the fiscal stimulus provided by the budget, tax cuts in the budget. We have the monetary stimulus provided by the last 2 rate cuts, repo rate cuts by the RBI. And our inflation is down to 3.61%. Therefore, the RBI has said that the monetary stance will be accommodative. There is a change in monetary stance of the RBI from neutral to accommodative. The meaning of this transition is that in the next meetings also the RBI is either likely to keep the rates unchanged or cut the rates. No rate hike is likely. That is the significance of an accommodative monetary stance. And also India's fiscal deficit and current account deficit are under control. So this is a very sweet macroeconomic scenario which very few other countries have. Therefore, we can expect India to be resilient when compared to other economies. That is a very positive factor.
So what should investors do now and what should be the investment strategy?
Well, investment strategy at any point of time should be based on asset allocation. Asset allocation should be the cardinal principle of investment strategy of all investors. But this asset allocation, what is asset allocation? Asset allocation is allocating our investable funds among various assets like stocks, fixed income like bank deposits, bonds, gold, etc. How you are going to allocate your investable funds among these various asset classes, that is asset allocation. And that depends on the risk profile of every investor. Some investors will have a high risk appetite. They can have more equity exposure. Some other investors will have lower risk tolerance, lower risk appetite. They should have a higher exposure to fixed income instruments like bank fixed deposits, debt funds, or even gold. Equity exposure should be lower. So the basic principle should be asset allocation. Now, if you decide asset allocation, based on your risk appetite, then you can decide how much I should invest to equity, and within equity, how much to large caps, how much to mid caps, how much to small caps. Then you can decide that. In the present context, as I have said repeatedly on previous occasions, I would again say that safety is now in large caps, particularly in financials. You have safety now. They are fairly valued. Growth is good. And there are other domestic consumption themes which will not be impacted by Trump tariffs, reciprocal tariffs, whatever they might be. For example, aviation, Indian hotel industry, telecom. Then there are modern digital platform companies like the former Zomato, now called Eternal, Paytm, Nykaa, PB Fintech. These are not attractively valued because many of these companies are not, most of them are not profit-making companies, but their growth prospects are assured. That's why they are called growth stocks. And growth stocks will always have a high valuation, a premium valuation. So for a country like India, the growth prospects of these companies are assured. Therefore, long-term investors can look at these digital platform companies. Then even when you talk about externally linked sectors like pharmaceuticals, for instance, the likelihood of a reciprocal tariff, a higher tariff on pharmaceutical sector is very remote now. Of course, Trump can do anything, but then he is unlikely to impose a tariff on Indian pharmaceuticals, at least in the near future, because that will be doing further damage to the inflation in US. And this segment is attractively valued. And this industry is an industry in which India has long-term competitive advantages. And therefore, this is one industry which, even though it is externally linked, it is one industry which investors should be thinking about and should be buying on dips. Then there are certain externally linked segments like capital goods. I have often talked about one of my favorite companies, Larsen and Toubro. You may not get 25%, 30% annual returns from these companies, but you will be getting decent returns, double-digit inflation in the long run. So this company particularly has huge order inflows. More than 1/3 of their revenue is coming from the Middle East, where they are constructing massive infrastructure projects because they have got a very good track record. So Trump tariffs, reciprocal, whatever might be the duty will not be impacting, because this is not the India-America trade, this is India-Middle East trade, and these are companies which have a very good track record. So these are the segments which investors will be looking at. One thing investors should always keep in mind, India's growth prospects are good. India's growth story is the best growth story. We have explained that. But there will be setbacks in the market. If you trace the journey of Sensex from 100 in 1979 to around 74,000 now, there have been many instances of big crashes in the market, big corrections in the market, big crises which impacted the global economy, Indian economy. All those crises were buying opportunities. So thinking about that, investors can, not in a big way, in a calibrated manner, in a stage-by-stage manner, investors can buy in their stocks in segments which I have mentioned now. There can be further setbacks, but these setbacks will be short-lived. In the long run, people who are prepared to wait patiently, handsome returns are certainly possible.
Thank you, sir. Thank you very much.
Thank you.